Ever wondered how you can trade stocks and ETFs without paying a single commission? Sounds too good to be true, right? Especially when you think about platforms like Questrade, who've built a reputation on offering just that, $0 commissions. But let's be real, nothing in the financial world is truly free. So, how exactly do they do it? How does Questrade, or any brokerage for that matter, keep the lights on and the servers running when they're seemingly giving away their primary service? We're diving deep into the inner workings of the brokerage world, peeling back the layers of revenue streams and exploring the strategic moves that make zero-commission trading a reality. Because understanding how this system works isn't just about saving a few bucks on your trades. It's about becoming a smarter, more informed investor. Let's rewind a bit. For years, commission fees were a standard part of investing. You'd pay a set amount every time you bought or sold a stock. It was just the cost of doing business. But then, the landscape started to shift. Technology advanced, competition intensified, and suddenly, those commission fees looked, well, a little outdated. Disruptive players entered the market, challenging the status quo and forcing traditional brokerages to rethink their business models. And Questrade, a significant player in the Canadian online brokerage space, adapted. They embraced the zero-commission model for ETFs and then, gradually, for stocks, recognizing the power of attracting a new generation of investors. But how do they replace the revenue they were previously generating from those commissions? That's the million-dollar question, isn't it? Let's start with a crucial point: they aren't actually making zero money. The term zero commissions is a bit of a misnomer. It means you don't pay a direct fee per trade, but the brokerage still needs to generate revenue to operate. And they do this through a variety of avenues. One of the most significant revenue streams for brokerages like Questrade is payment for order flow, PFOF. Now, this is a bit of a controversial topic, but it's essential to understand. When you place a trade, your order doesn't necessarily go directly to the stock exchange. Instead, it might be routed through a market maker, a firm that facilitates trades. These market makers are willing to pay brokerages for the right to execute those orders. Why? Because market makers profit from the spread, the difference between the bid and ask price of a stock. By executing a large volume of trades, they can capture small profits on each transaction. And they're willing to share a portion of that profit with the brokerage that sent them the order. This is PFOF. Think of it like this: you're a restaurant owner, and a food delivery service sends you a ton of orders. You might be willing to give them a small percentage of each sale because they're bringing you a high volume of customers. It's a mutually beneficial arrangement. Another key revenue source is interest income. Brokerages hold a massive amount of cash in their client accounts. This cash isn't just sitting idle. They invest it in low-risk, short-term instruments like treasury bills. And they earn interest on those investments. With millions of clients and billions of dollars in assets, even a small interest rate can generate a substantial amount of revenue. Furthermore, margin lending is a significant contributor. When clients borrow money from the brokerage to trade on margin, they pay interest on that borrowed capital. This interest can be a lucrative source of income, especially during periods of high market volatility when more traders are using margin. Beyond these primary sources, brokerages also generate revenue from premium services. Questrade, for example, offers advanced trading platforms, data subscriptions, and educational resources for a fee. While basic trading might be commission-free, these value-added services cater to more sophisticated traders who are willing to pay for enhanced features and insights. Foreign exchange, Forex, fees also play a role. If you're trading stocks in a currency different from your base currency, you'll likely incur a currency conversion fee. This is another area where brokerages can generate revenue. Let's not forget about securities lending. Brokerages can lend out the securities held in their clients' accounts to other financial institutions. This practice, while regulated, generates income for the brokerage. Now, it's important to address the potential concerns associated with these revenue models. PFOF, for instance, has raised questions about potential conflicts of interest. Critics argue that brokerages might prioritize routing orders to market makers who offer the highest payment rather than those who offer the best execution price for the client. However, regulations are in place to ensure that brokerages prioritize best execution. They're required to route orders in a way that provides the most favorable price for the client, regardless of the payment they receive. The shift to zero-commission trading has also had a significant impact on the brokerage industry as a whole. It's democratized investing, making it more accessible to a wider audience. Younger investors, who might have been deterred by high commission fees, are now more likely to participate in the market. This increased participation benefits everyone, as it contributes to a more vibrant and efficient market. But what does this mean for you, the individual investor? It means you have more options than ever before. You can choose a brokerage that aligns with your investment style and preferences. Whether you're a beginner looking for a simple, commission-free platform or an experienced trader seeking advanced tools and features, there's a brokerage out there for you. However, it's crucial to remember that zero commissions don't equate to zero costs. While you might not be paying a direct fee per trade, you're still incurring other costs, such as the spread and potential fees for premium services. It's essential to understand the full cost of investing before making any decisions. The reality is that Questrade and other zero-commission brokerages have successfully adapted to the changing landscape of the financial industry. They've found innovative ways to generate revenue while offering a valuable service to their clients. It's a testament to the power of competition and the importance of adapting to change. The move to zero-commission trading has been a game-changer for the investing world. It's made investing more accessible, democratized the market, and fueled innovation. But it's also important to understand the underlying economics of this model. By understanding how brokerages generate revenue, you can make more informed decisions and become a smarter investor. With that said, thanks for watching, and until next time.